Good afternoon, everyone. Thank you for joining today's Ask Me Anything session on how to determine your company's valuation. My name is Christina Wood, Director of Programs here at the Start and Scale team at Communitech, and I'm so thrilled to have you all join our session this afternoon. So before we get started, I just have a few housekeeping items that I would like to review with everyone. So just as a reminder, today's session is being recorded. You can find all of our past Ask Me Anything sessions on our website at communitech.ca. So we are using these sessions as a resource for companies to refer back to at a later date. We also ask that you please keep your microphone on mute for the duration of today's session, and please feel free to ask any questions that you have using the chat functionality. So our speakers today are eager for this to be a discussion, so please put any and all questions in chat. We did have a number of questions come in with the registrations, so we'll try to do our best to get to those today as well. There are a few that we'll have to probably do individual follow-up emails on, so we'll make sure that those get out to you. And lastly, this session is meant to provide general guidance. So we're looking to keep things fairly high level. If you do have a specific question to your company, our speakers are happy to chat with you at a later date. And in fact, they will be doing some office hours with Communitech on May 26th. So you can connect with our investor team to get set up for those. So that's at investor@communitech.ca, and I'll put that in the chat after as well. So with that, actually a couple of upcoming Ask Me Anything sessions that we have. So next week is how to improve the maternity leave process for your employees. Cybersecurity, we'll be having a session on the COVID-19 toolkit for businesses, so looking at vaccines and screening and what's legal and not. And then the beginning of June, we're back on an investment topic of cap tables. So make sure to join us back on June 1st for that session. And so with that, I will turn things over to today's speakers. So I'm so grateful to have both Laith and Matt join us today to talk about valuations. It's an important topic and one that we get asked about a lot at Communitech. So with that, I will turn it over to the two of them to take us on today's discussion. Thank you both for being here.
Awesome. Thank you, Christina. Hello, everyone. Happy to be here today. Kind of give you an overview on sort of valuations and kind of just walk you through sort of like a quick 101. Just real quick before we get started, if you have any questions, just feel free to just drop them in the chat. So I'm going to keep my eye on the chat as we're going through. If there's any questions that we can tackle right away, I'll sort of incorporate them into the discussion. And then anything else that's kind of lingering at the end, we'll sort of go through that as well. So my name is Laith. I'm the Senior Market Development Manager at Silicon Valley Bank, Canada. I basically lead two initiatives at the bank, so early stage practice, where I work with all companies that are pre-Series A, either from a funding, mentorship, guidance, connectivity perspective. And the other sort of initiative I lead is I manage all our partnerships with the different incubators and accelerators across Canada. And I'm really, really excited that I'm joined today by Matt Roberts, partner over at ScaleUP. Matt, if you could please introduce yourself.
Yeah, sure, Laith. So I'm Matt Roberts. I'm a VC at ScaleUP Ventures, where I'm a partner. I lead seed and Series A investments, occasionally a B, but that's pretty rare for us. I've been a VC for 15 years. I was at BDC and Wesley Clover before that. I've also founded my own company and raised a seed round and exited that. It was not a particularly great exit, but it was an exit. And so, yeah, that's me in sort of a quick nutshell.
Awesome. Okay, so I think specifically that part is going to be super, super handy as we go through the conversation today. So first thing to kind of just kick things off, and we're just going to kind of go through like quick definitions on sort of valuations and sort of like the different components that go into the valuation. So Matt, if you could please just kind of like define sort of like what is a valuation for a company and why is it so important for a founder, or why should it be?
Well, you're selling your company and you want to get a good price for it. Obviously, most founders are very sensitive to selling off their business or portions of their business to others, and they want to get the most opportune price. So that's a function of a number of different things. Like the nomenclature is pretty simple for people, I think, and I think most people on this call will get it, but we'll just go through it in case there's somebody on here who doesn't. So I guess within the there's a pre-money valuation, which is the value we place on the company as it stands today. There's the post-money valuation, that would be that pre-money valuation we talked about, and then the cash that we're investing, and that would give you sort of the post-money valuation. And you can sort of work out from there our percentage ownership from the percentage of the company we bought for the amount of capital. So I'll give you sort of a quick sort of and dirty way of doing it. We're more often than not, we're buying equity in these situations, although there are terms and conditions that might make it less sort of equity-ish. And I guess, you know, some people define their investments on how they do a return on investment sort of, you know, metric, but we, you know, in the earlier stages, that's a little bit rare, I guess.
Yeah, I think return on investment specifically, I think like seed, pre-seed, and even like the ideation phase is a little bit sort of tricky there. So yeah, so I mean, another sort of interesting thing to kind of talk about is who are the different sort of participants that would sort of determine this valuation. So where does it actually come from, or where does it kind of originate? Is it, you know, solely from the founder? Is it only from the investor, or is it sort of like a negotiation, or is it sort of like a dynamic back and forth?
Well, it's a market, right? So you create a market by finding a buyer, and you have a seller, and they come to an agreed upon price. That's how you determine what your value of your company is worth. If who that buyer is can be a VC, it could be an angel, or it could be somebody who just said, "Tell me what the price is, Mr. Salesperson." The entrepreneur is the person who's selling the equity, so that's how they're determining where's their comfort level of what they're willing to give up in the company for the amount of price they're going to get. A function of a healthy market is your ability to get in front of as many people who have capital to try and find out what you think your pricing should be. So the more people you chat with, the more information you're going to get, and the more comfort you're going to get around what a price should be based on the market. And some people have a very limited market. For example, if you're in an earlier stage, there's only a certain amount of people that would be willing to give you money when there's perhaps no product and no customers. So that limited market is generally what we call the friends and family round, and so that's more of a trust network investment rather than a venture sort of financing where we're sort of looking at the customer base and the existing product.
Also, I mean, because this is sort of like a negotiation, just kind of like how you mentioned, it's a market and there's sort of like a dynamic. So how actually do you go about sort of like doing that sort of negotiation? How do you actually go through that dynamic?
How do you do it? You know, it's one of those things where you're going to find that you'll find that as you do more and more conversations around what your company is like and the attributes of your company, you get a stronger conviction on what the good parts of your business are, what perhaps are the weaker parts of your business story, and who invests despite those weaker aspects. So you're constantly looking for people who will accept a component of the risk of your business, and that's how you figure out whether or not you have a buyer. So it can be small numbers of customers, product not yet being built, or only in the hands of a few trusted customers to try out. Some investors like that, some investors don't. You start to get a better sense of how big that market is, and then as you talk to them more and more, the value in your head perhaps is being discounted by the VC or the investor based on the fact that you're missing some of these components. So that's how you sort of get to a negotiated point of what you should have a sense of what your valuation should be. In the earliest stages, it's a bit of sticking your finger in the air after you've stuck it in your mouth, just trying to figure out which way the wind's blowing. The valuations sort of ebb and flow as market conditions change and cash availability in the market is. For example, about 5, 6, 7 years ago, there was a lot of exits out on the East Coast for a brief period of time. That angel market kind of went crazy. And so valuations there were actually higher than they would have been in Toronto because not a lot of tech companies, quite a lot of risk capital available who made money in previous exits, all trying to jump into the same businesses. For example, we've also consistently see higher valuations for companies out in Vancouver and BC, mostly based around the fact that there are tax incentives for angel investors. So they're a little bit less inclined to negotiate on pricing in the earlier stages than VCs are. So that's why they have such difficulty out there.
Yeah, I think also what we're starting to see now in our own sort of ecosystem in Canada is just with all the different sort of exits, or sort of like the different billion the excess $1 billion valuations. I think that might start to heat things up back again, if they weren't already coming into this year to begin with. So the other sort of like follow-up question to that is, because we've now established that it's a sort of a dynamic and it's based on sort of like some elements, specifically those elements we're going to talk about in a little bit. How would I know then as a founder, and obviously as a founder, I'm a little bit biased. I want to kind of go for the maximum sort of like highest valuation that I can get. Meanwhile, on the investor side of things, you're trying to get, the valuations a little bit lower than that and kind of try to set expectations. But there is sort of a little bit of a dynamic there where some investors might try to lowball a founder, or in some cases, a founder might try to argue for an extra high valuation. So could you talk a little bit about that sort of like dynamic?
Yeah. So yeah, everybody wants to get a deal. Nobody wants to feel as though they've overpaid or been underpaid. At the same, and that's not I think that's just human nature. I don't think that's necessarily nefariousness. At the same time, a fair bargain is a bargain where not everybody gets what they want. And so, but what you'll see is that in places where risk capital is less available, right? That you start seeing some types of investors sort of thinking they're the only game in town, perhaps, and certainly being aggressive in how they price or get involved with businesses. And sometimes they don't. It's not about the pricing; it's about the other little bits and bobs. So we'll see angels, invest in a company at a perfectly reasonable valuation, but then they'll call up the founder and say, "Hey, by the way, since I'm sitting on your board, or since I'm providing advice and help, you should give me some free shares or options in the company." They're effectively actually lowering the price that they just paid by getting those shares for free. So they're sort of doing a backdoor devaluation of the deal they just made with you. And for some reason, it seems to come whenever there's a big increase in pricing. We see that those sorts of games start showing up again, and this time is no different. At the same time, there's a lot of founders who have a cachet based on where maybe they worked before or on the success they've had before, getting themselves very healthy valuations from VCs. But those VCs are investing in them usually as they are not seed or Series A funds. They're sort of later stage funds, and they're investing in order to just have guaranteed access to that deal. So there's sort of, if you want an investor that is thinking about your next round, they're going to make a binary decision on how they view the company. It's either a successful company that they'll continue to invest in, or they'll orphan you later. And that's what they're doing. And if you're a founder who's comfortable with that reality, then you can get a better price if you have something interesting for them. But if you're still germinating your ideas and you want to experiment more, it's probably better to work with founders, VCs who have that sort of mentality to experiment alongside a founder to figure out how to build a better business. And that's where you start seeing the dynamics of who you take money from, maybe at slightly lower valuations, just because their fund sizes and dynamics make it difficult for them to play outside those sorts of walls.
Yeah, that's actually a good point. So there's two scenarios that I kind of wanted to just ask for the benefit of the audience. So one is, let's say scenario A, where an investor actually ended up getting their way and managed to actually lowball or get that valuation like really, really, really low and take like a massive sort of share in the company. And then scenario B, where the founder got away with it, negotiated that super high valuation. So can you sort of like talk about the different sort of drawbacks, or what the scenario or what the reality that they find themselves in right now in both?
Well, in today's environment, prices are going up, so and capital is highly available. So perhaps the founders will be immune in this particular dynamic. However, these market conditions continue to sort of ebb and flow, right? Like we saw peak out evaluations in late 2017, early 2018, and then there was a sharp decline in the first quarter of 2018. Then you saw 2018, 2019 doing quite well again. I'm not quite sure why. Market, it's usually public market conditions and healthy euphoria, as they call it, trying to do these things. But in reality, I think what we're seeing today is probably in some ways less sustainable on the earlier stage and more sustainable in the late stage, because you're seeing very healthy growth metrics in our late stage deals. But in the earlier stage, we see it much more difficult to get these things going. So talent is becoming a much more pronounced issue in the earlier stages, and the Canada's healthy talent stocks, I think, are beginning to become eroded. So we're seeing more money needed to launch early stage companies. So, and those metrics to get there is becoming harder and harder. So, I think what you're going to see is that early stage founders who gave away the company are going to feel the pinch there on the ownership side, and then companies that raised at too high a valuation are going to be coming in these sort of living dead moments where they have to either take a lower valuation or grow the company incrementally until they can sort of meet the previous valuation expectations that they achieved. So
yeah, can we talk about that for like a little second, just kind of like flesh it out a little bit more. So what does it mean then for a founder, like in sort of like the real life scenario where it's like you now have to take a lower valuation, sort of like inch towards, sort of try to build out the company, meet the previous valuation expectation, and then
so if you're raising on safes, this is not going to affect you so much, but you're going to find that you pay the bill a lot later on. And Laith, you've been in transactions with me where we've watched founders suddenly do the math and realize they gave away 40% of the company.
Yes.
Before they got an A round, because they'd just been raising safe on safe on safe. And then they put a lot of pressure on the guy pricing that next round to say, hey, well, wait a minute, dude, I'm about to give all these safes are going to convert and I'm going to lose 40% of the company. And the Series A lead, sometimes me, is saying, well, I'm not sure what you're supposed to do with that. Like, I'm not making it like these guys, you gave away the company. That's not my fault. But what you're going to see in priced rounds right now is that companies where they've given away a lot of the ownership, it's going to be very hard for them to get it back. They've essentially given away a big chunk of the company, and that's going to be very negative for them. In the cases of companies that have raised at very senior valuations, if they have to do a down round, there are a number of mechanisms that will become kind of painful for them. So we have very often in price rounds anti-dilution rights for the investors. They can be weighted average more often than not nowadays, and so for every dollar you lose, you're probably giving up 10 to 25%. So the investors will get back more of the company, and it can be very detrimental and very negative, and it has all of these knock-on effects in your business. It'll mean you have to reprice your options. You'll probably have to top up your existing employees. You'll have to think about a new ESOP in order to do so. It kind of becomes a self-fulfilling prophecy of founders being diluted further.
Yeah.
And it can be very negative, and it can be disheartening to quite a number of your employees and yourself. So you hear all these people say, don't take the crazy high valuations because there are bad effects, and then the founder doesn't listen to you and does it anyways, and that's their prerogative. But they're betting on the fact that they will continue to have a complete healthy upward curve, and no business I've ever worked on is in that zone, unfortunately. So
yeah, it's just the assumption that like you're just going to have that sort of like very sort of like hockey stick style curve.
They're like every one of the companies that we are celebrating today as having reached the $1 billion valuations or even the $500 million valuations. I'm afforded a very close seat to how they've performed over those periods of time, and unfortunately, it's just not true that they were up and to the right the entire time. Many of them stumbled in their first or second rounds to show the results that were necessary, and they took a punch. And I always say to my founders, there's going to be a moment where we are going to have to take a punch. If that's either me or you or somebody, but we're all going to have to take a punch in this business because we didn't execute correctly. The metrics are not where we need them to be, and that it's a very hard conversation when that happens. You might just run out of money, and you need your existing shareholders to show up. And if they feel like they've been hard done by in the valuation exercise with you, they might be less willing to show up. right? Or if they show up, they might take a little more of a pound of flesh, right? So, you know, these are relationships where you might need these people later, right?
That is actually like a very good point to kind of mention, where it's just like, if they feel hard done by, there might be sort of like a renegotiation of like, you know, like the different positions, which brings me into the next point that I kind of wanted to talk to you about, which is like from a VC perspective, right? You're sitting across the table, you've got a founder, they pitch to you, you know, they say, I want X, like basically I'm valuating my company at, you know, at X. In your mind, from your perspective, Matt, like when you're thinking about it, when you're thinking about like the fund, when you think about the unit economics, deployment of capital, like what basically goes on in your mind on your end when you're, you know, when someone sort of presents to you a valuation?
Yeah, the value, so there's a lot of different opinions here. VCs will say different things. My opinion is I'm very happy to hear what an expectation level is from the founder and what they think their business is worth. It allows me to understand whether or not A, they've done their research yet or not, and B, whether or not I'm even in the potential running to do this sort of thing. If they're so far away from where I'm going to be, being a truth teller at that point is kind of like detrimental to yourself. You know, like some guy says, hey, I think my company is worth $100 million. You just think it's worth 10. You know, like, really, did they do their job? Did they do their homework here? So it gives you a sense of founder thoughtfulness and whether or not they've been researching and thinking critically about this. I see some people just on the side here. I'm sorry, Oxmode, cool name. You know, asking about would you hire an agent to figure this out, and like probably not. Like talking to an agent is fine. Like paying an agent for this, no. You know, like they're pricing it against you know, some attributes. VCs price it against what they're seeing in real time in market, and in this market right now, it's kind of a weird dichotomy where you have this really thin front end where, you know, 75% of the money that's being spent today is in the late stage, so we can ignore most of that, right? 25% is happening in the seed, series A and B categories, and that 25%, it's feast or famine. It seems to be going on in the Canadian market and in the US market, where I have some visibility, and those are on the mostly coastal. The problem we have is that there are some deals that are just insane pricing, and I can't even fathom why it's like that, and I can't explain to you with all my 15 years in this business why it's like that. And then there's other deals that can't close around that look perfectly reasonable.
Yes.
And I just don't know what the problem is. There seems to be a dearth of early stage leads out there coming into that market right now, and it just seems to be, they all seem to be struggling.
My question was more value, like what you're, you know, I guess our company's bought, not sold, but there are a lot of, we were in a space nobody was in, but now Andreessen Horowitz just invested in a company without a product that's doing the same thing we are. So we have a number, and we've had in like a month 4 people approach us. We had no idea what we were valued at until this month.
Well, that's good. Like, you know, like if you have a comparable out there, that's a very different beast to be part of, right? Like, you know, we've seen that, like, you know, for lack of a better term, the also rams, like there's this one star that a serious VC or somebody who's very expert has expertise in that particular space has come in and done an investment, and then, you know, other VCs start looking for a company that has those same attributes or those same abilities, and then it allows them to get that investment thesis started in their firm. So we, you know, on a personal level, like I did an investment in a company called Sonder, which was called something else when I did it, but it's Sonder now. We were one of the first in market within, you know, Spark Capital, Greylock invested in it, and all that sort of stuff. All tier 1 VCs. Those is the minute those guys showed up, like every other firm started looking for the other versions of our company. Right. Yeah. And it's not a bad place to be, but you need to make sure that they're investing not for the, hey, we missed out on X, and so we're going to have this other one. You need to make sure that they're actually bringing lots of value and knowledge to the table, because they can be detrimental.
Yeah, we're in a position where I'm probably not the best qualified to answer some of the questions I'm getting asked. That's why the agent, you know, a bunch of, you know who they are, like, you know, they deal in M&A.
If it's an M&A discussion, there are lots of great people who do that. If it's an investment side, I wouldn't use an agent at
Right. So M&A,
half of my deals for exits have included an agent, and half have not, and it's mostly a function of how big the value of those exit negotiations are going to be and how many players there are. Right?
So what would
like
threshold where if it's over 10, take an agent, under 10?
I think agents over like 25 to 35, because they just need a minimum fee structure to make it worth their time and effort, though, because they've got enough deal flow, that they need to make the fee. So they'll just take more and more away from the company if at lower and lower valuations. So it's a valuation discussion. If you're doing less than 20, you're better off with just a smart lawyer.
Right. Cool. Thanks for your help, Pat.
Yeah, no worries.
Awesome.
Good luck, by the way.
Thanks.
I just saw another question in the chat. So this is from Sherry Lee. Hi, Laith. I have a question. When do you or Matt think is the best time to get the first investment for a startup company? Thanks very much.
Well, that's a kind of open-ended question, isn't it? Like whenever you need money, I think if I'm assuming that your company is a little bit earlier in its stage, right? And I think who that money's from and what you're getting from that money is important. Like you need to eat, right? And you need to pay yourself salary in order to eat. So if this is something to do that, then bring the capital on. But you need to make sure that the investor you're bringing that capital on from is well aware of where your stage is at. A lot of what I would call wealthy, well-meaning angels sometimes invest in what they think they see rather than what is there. And I think you need to have a frank conversation to make sure that's there. But I'm not against raising capital as you see fit as a founder. Like raise it as you need capital, right? Like this is a business where everybody should be, and most internet websites, when you Google angel investing, will inform you that you're probably going to lose your capital. So if those people are well aware of that and they're professional investors, then go for it.
Yeah, just my quick take on this, and just working with early stage founders was essentially working backwards from like where you want it to be in about 6 to 12 months, figuring out like the different sort of expenses, figure out the different sort of cost of capital, cost of expansion, hiring, talent, etc., development, product, you name it, and then just sort of figuring out the round and then figuring out the players and then going after the players. Yeah. But to Matt's point, it's setting the expectations. And
yeah, if somebody shows up with a check though, and you haven't raised any money, then go for a safe. Just pick up a safe, get it done, and value the company and give that maybe a discount to sweeten the offer, and then find a pricing agent. The reality is that the reason we're seeing so many safes all of a sudden out there is that a lot of the early stage VCs and seed investors have decided to lower their check size. So it was very unusual to see $100,000 checks from VCs. Now it's not so unusual at all. And then and to not price the company at all. And that is good in the sense that it means that there's a lot more people to go and ask for money from. It's bad in the sense that you don't actually know what you're giving up and what they're getting. And so there's a dichotomy going on in the ecosystem where nobody can find a lead. Everybody can find follow-on checks, but finding a lead seems to be a major problem in the Canadian market, and I'm seeing it now in the US market just as much. There's just nobody wants to be that truth teller on what a price of the company's at.
So that's actually a very interesting note on the US, because the next question is from Jonathan Schlew. I've heard USA is far more lucrative to raise capital in. We are located in Toronto. Is it true? Worth going to the USA instead of raising here?
So nobody's going anywhere. We can do it on video. But yeah, no, listen. So my US counterparts are playing a very different game than the Canadian ones are. So up until very recently, leads in the conversation we just heard with Adam, is that you've got you don't have early stage companies exiting, right? So you have to be 100 in Canada. The average company price for a sale was something like $100 million. In the US, it was 16, right? And so what is going on is that American companies don't acquire early stage Canadian companies, and Canadians don't acquire early stage Canadian companies. So the problem is us VCs who are in the early stage, we got to build a real business. Otherwise, we don't get anything. We're sort of playing the game with no net underneath as well. We're up in the rafters there. And the reason is that our US counterparts are doing talent sales much more frequently. So talent acquisitions in the States were bread and butter for many VCs. A lot of early stage VCs actually had somebody on staff whose only job was to sell teams after the company failed to the big players, and then they get their money back. Then they would generally do it about 30 to 40 or 50% of the time. So that's what was going on. You'd have the American VCs say, absolutely, we'll invest in your early stage company, because they just sort of say, if it works, great. If it doesn't, we'll probably get 50 to 80 cents on our dollar back in a transaction with, maybe Yahoo or Google or one of those companies will pick up the team from us. So that's why you always see the US VCs say, yeah, you absolutely will invest in you, but come down to the States, because they can sell your technology team to one of the big players. In Canada, we haven't been able to do that. We still haven't been able to do that. Shopify doesn't buy talent acquisitions. So, my angle would be, yes, it's easier to go down to the States and get money, but very often the game that they're playing and what those early stage US VCs are learning is they can't as easily bring the teams down there anymore. So that's why you've seen a slowdown in the Canadian investments from the US players in the earlier stage. In the later stage, the Americans are all over us now. They're coming into every single deal they can get their hands into.
It was a very interesting conversation I actually had with one of the VCs that was based in Boston. This was back in like the winter of 2017, where they were actually just starting to get more and more interested and active in the Canadian ecosystem. So one of the things that just basically drove them was you have larger and larger deals happening here, so it's a little bit more excitement. There's a lot more competition for them to deal with in their own yard, so it's actually easier for them to come to our side of the border and basically do the investments here. Also, currency-wise, it's a little bit cheaper for them to come in, participate in the round, or give it like a higher valuation because the dollar is sort of like power. But there's a little bit of a half truth with regards to like the lucrativeness of as an early stage founder just going to raise in the States. There's a lot more competition between you and sort of like the global level, at the global level, sorry, where it's not just Canadians going to raise in the States. It's either Germans, Arabs, West Asians, Far East, etc. Like anyone that's sort of traveling to the States to go raise in the States, everyone basically going to the Mecca that is Silicon Valley. So a lot more competition. They get the chance to kind of, they get the pick of the litter. They get to pick whatever they want. They get to price it the way they want. So there's a lot more sort of hurdles there than would seem on the surface. So just be wary of those points.
Yeah, I'd also say though that I've seen a lot of good companies not be able to find their lead VC in Canada, and then a US VC shows up, and then all the Canadian guys jump on them for FOMO. So there is a little bit of go out there and find your US lead if that's what you need to do. I'm not saying don't do that, but just be aware of the dynamic that they're trying to play and what you may be able to use it for your own purposes to get the company funded, right? So
yes. So real quick, the next two questions are about how we do, or like what the frameworks are for valuation, which we're going to start talking about in a bit. Jonathan, you're asking a question, what does SAFE mean? So that is simple agreement for equity. We will also be tackling that just in a second, as well as Catherine's questions about the safety of safes, funny enough. Anyway, so Matt, back to the sort of like topic at hand. So what different methods do you use, or does a founder have at their disposal when they're trying to figure out like how to evaluate their company? So let's this is a fraught conversation, and it can get fraught because founders compare themselves on one number and then realize that somebody got a better valuation than them, and they're saying, well, that doesn't seem fair. And first of all, life's not fair, I guess, but in a certain way, there are three metrics that are the harbingers of your valuation, and there are subcategories of all those that will get you. So very briefly, growth rate of your company, right? Top line revenue, how much revenue you're getting, and margin. If you those three metrics are the ones you should be looking at the earliest stage to understand what kind of evaluation you're getting. So I have companies that have 90% margins, right? And a reasonable growth rate. They get much higher valuations than my companies that have
high growth rate with very low margins, right? And because quite simply, they're able to turn over cash within their business much more quickly. So they're self-financing to some extent after they get started. So they're much more likely to be able to continue growth without anybody needing to put more capital. So they're capital efficient. You'll probably hear that VCs talk about that stuff. That's why we like those, because I drop in $2 million and that $2 million goes for a long ride internally before they need to come back for more cash. Whereas if I have a lower margin business, that $2 million is probably gone much more quickly, and I'll have to refinance it. Now, at a higher growth rate, it might be that it's a bigger business overall, right? So margin is what we're looking at. This is why you see VCs shy away from e-commerce predominantly, because it's great to have top line revenue and a good growth rate, but if you're selling a t-shirt, generally you're making them only about 10% on those t-shirts, right? So we want to make big high margin opportunities and a healthy sort of curve, and then we start getting into market sizing, things of that nature that start also goosing with markets. But those three that I would mention at the front end, those are the ones you want to be looking at early on.
And how then do they, do they change as you're sort of like evolving, going from like seed extension or seed series A?
Yeah, well, seed extension is usually because you didn't get the A, so that's usually a growth rate curve problem, right? So when you raise money, ideally you should be getting 18 months and some major milestone, either a revenue milestone, customer milestone, something that shows the next guy, as we like to say, greater fools in the greater fool theory, that this is an ongoing concern of business that will continue to grow, right? And so in the sense of if you find yourself needing an extension, and it's not unusual, I'm doing an extension right now for one of my companies, you'll find that maybe your extension actually becomes your next round. It becomes, people buy into that. Yeah, you didn't get to that metric, but we believe that metric is not really the measurement here. We'll get there. I find that whatever I thought the metric would be at the investment cycle I did, and 18 months later, I'm looking at multiple metrics that turn out to be harbingers of whether or not this is a great company or not. So you don't necessarily need to keep the same metrics from round to round. But I would encourage people when they're raising money to raise as much as they can, but like also to have a very clear identity of what the next round looks like. I have never in my career have I invested in a company without there being follow-on rounds. That's one of my claims to fame, if you will, is that I focus my companies on raising further capital. And that otherwise, it doesn't go anywhere, because I can't sell these early stage companies, as I mentioned earlier, that you just can't sell them in Canada. So I have to have real businesses that grow.
That is actually like a really good way to think about it with regards to sort of like venture capital, is that the fact that, yeah, like the momentum needs to be there, the raises need to be there needs to be like a rhythm to it, sort of.
There has to be a beat to the business. Every founder creates their own beat to their business, as I like to say. They're sending the sort of the thumping as the team rows together, perhaps.
Yes.
But at the same time, it has to be to a goal, right? And everybody has to be more or less aligned as to what that goal should be.
So just real quick as well, like you mentioned sort of the three harbingers of valuation, as you called them. Can we also talk about sort of like at the early stage, what other element may play into this?
Yeah, pre-revenue, it can play a little bit different, or early revenue perhaps. It's going to be space, it's going to be technology, it's going to be founders. Very often, actually, founders are probably the most important aspect of the company at that particular stage. And I hate to say what that is, because it seems to be different. I was thinking through all the founders I've backed over the years, and they're all different guys. Yeah, well, most of the founders I've worked with, Laith, and they're all very different people. They share an attribute of growing a business and being entrepreneurial. So I guess there's that sort of baseline, but like beyond that, they're all very different individuals, and how they approach how they want to build their businesses is always very different as well. And my job is to merely enable them to do so. Their job is to figure out how to do it properly. So
awesome. All right. So this kind of leads us into the questions that I saw in the chat, but also just sort of like towards the end of like our discussion, like, for valuations today, before we like open it completely for like questions. So as a founder, like trying to raise, and I see all this complexity and trying to figure out like my, my valuation. I talk to several people, I get a different valuation from each one. I'm trying to figure out like which one's the right one. There's a lot of complexity. I just want to run my business. I need to just raise money, get money in the bank so I can actually just, get back to work. Sometimes I'll decide to go for a different sort of instrument. So I'll either go for a note, I'll go for a safe, and I'll basically decide to kick the valuation down the line, kick it over to the next person, or the next time we, next time I raise capital. What are some of the drawbacks to that? What are some of the advantages to that?
Well, so, let's go through the history of this quickly. Convertible notes were instruments for short-term cash into a company where pricing was not, they didn't want to price, or the company was going through a moment where they might need to make a change. So convertible notes were, hey, I'll give you money. I now have a debt, so I rank above all the equity and everything else in the business. If should the company go bankrupt, I get paid first, right? If you complete another round, this convertible will convert into that round's price at a discount, perhaps with an interest rate, perhaps not. The idea is this is the riskiest capital. The company is in this in-betweener zone, right? It's either not going to get to a round and it's going to go bankrupt, or it's going to need to be sold. And so I'm ranking my capital at the highest level, and so I can get it back. Or there is going to be a round and I want to get a discount for having been putting capital into the company at a time when nobody else would, right? Before that round happened. So that's what that discount is for, so to provide sort of a return on the conversion process. The convertible notes were used predominantly late 2005 to sort of 2015. They're still used today. But they're sort of in-betweener zones. We use them when you see an seed extension, for example. Very often they can be a convertible note, right? It's a debt instrument that is provided by VCs. It's not an equity instrument, but it's a quasi-equity instrument, because sometimes we'll put a cap on that note. Say, oh, it converts to $20 million and no higher, right? And so even if you raise money at $25 million later, mine's going to cap at 20. I'm going to get my chunk at 20. So that's why it's got a quasi-equity, quasi-debt sort of aspect to it. They were using convertible notes all the time in accelerators at the very, very early stages. That's where they back in sort of 2010, 2008. And what happened was it became very clear that it made no sense to have these quasi notes when rounds were happening very quickly right after the accelerator did it. So you did a convertible note day one of the accelerator, you graduate 90 days later, and then you have a round maybe. And so this note's been out there for just 90 days. And these were legal instruments that were pretty like not nefarious, but they were complicated because they required a lawyer, because they are a debt instrument. And they complicate the Series A round a little bit. Y Combinator in their infinite instrument said, well, we're going to provide safes. So it was essentially like you buy an option to have equity in the company at a later date at the price that round happens at. That's what it was. And the idea was to make it simpler for these convertible notes that were only going to be around for 90 days, because you start day one at the accelerator, you get the safe. Day 91, you do a Series A round, because it's Y Combinator. It happens all the time. So that's where safes came from. And everybody thought Y Combinators decided safes are what we should use. And so people stopped using convertible notes and only used safes. And angel investors started using safes, and early stage VCs started using safes. And safes are not meant for this. They were meant to be very short term, 90 days, like notes for equity, right? Because if the company at a Y Combinator didn't raise money 6 months after day one of the accelerator, it was never going to go anywhere. It's usually dead, right? 90% of them died. So that it was just easier to turn off the company without this huge debt load on the books, right? And so today we have safes everywhere, and people have taken the safe document off the YC website. They say, well, we'll use this safe. But a whole bunch of people have sort of made their own versions of safes. And the way they do that is they actually have another piece of paper that you don't see on the website that has all these rights and conditions, because, hey, I gave you money, I'm a VC firm, I need to tell my investors what your company's doing. So give me information rights. So you sign that. And then, oh, also, I want to make sure I have pro rata rights. It's not in the safe document. So can you sign this piece of paper? And suddenly the safes are actually difficult to read as the convertible notes. And YC is guilty of this too. What they don't tell you is that there's a safe document and then there's own personal rights and privileges document that they don't put on the website. And so suddenly safes have become much more difficult and much more complicated. And no longer 90 days. Many companies have safes that they've been riding for years. My wife runs a company and she got her safe in 2016. She still got safe. And I don't think anybody there expected that. It's not good. And then as you raise more and more safes, the way they convert can be very difficult and detrimental to the point where you can give up a big chunk of your company. So safes were a mechanism for short-term raises. They were not meant to push out pref rounds of equity purchases, and that's what they've done. And so we now have a lot of companies with a lot of difficulties trying to convert these safes. And if you in a time of high valuations like today, it's less painful. But in times where the valuations are lower, it can be very painful. And so they can be very dangerous if you don't stack them up properly.
Yeah. I think, yeah, I mean, we had that, like we've had those cases, like, that we've seen where you've had multiple safes and all of a sudden someone's getting absolutely taking the task about their ownership and realizing just how much they gave away without really knowing at the time. I was going to say there's two really good resources for this. They're both written by the same person, Elizabeth Yin. She's the GP over at Hustle Fund. She talks a lot about the safes, and I guess the new and improved sort of safe that YC is using, but she still sort of has the reservation around, like, yes, like these things are good instruments, but they're not meant to be used sort of to be stacked on top of one another, etc.
No, we're year 8 or maybe 9 now into safes, and there's been 6 versions of them. Like it tells you that the first versions didn't work very well, whereas convertible notes have been around for 25 years before we started really using them in early stage, and pref rounds have been around forever. So, and there's a whole bunch of alignment issues. Like if you have an uncapped note, your investors are not incentivized to help you because they don't want your conversion at such a high price, right? So there's a whole bunch of, it's just not a great alignment tool. And I generally shy away from them. Well, as you know, I've never not priced around. I price every single one of my deals. I think my money's in. I'm aligned. I'm backing the founder to the hilt, and that's the way we go. But in the earlier stages, it's much more difficult to find somebody who will price. So I can understand why safes are being used much more often than.
Yeah, and just in the interest of time, we can open it up to questions now. And I think there's just a few questions that I just need to scroll up and kind of see. So we kind of tackled about the safety and sort of the unsafe or safe safes. So right now from Diana, hi Matt, I run a high margin B2B business established in 2012, which recently pivoted from services to product. We have clients from service side and in the process of moving them onto product platform. The question is, should I bootstrap another 3 to 6 months until first few clients are subscribed, increase valuation, then fundraise, so seed 2 million raise, or fundraise now, lower amount, pre-seed 500K on a lower valuation, but gain time to market?
Yeah, these pro services to SaaS businesses conversions, VCs shy away from a lot. And Laith actually and I worked on one where I was on the board for a while, where we did that conversion, and they take time. VCs, not all VCs, but many VCs shy away from them until the Series A's. It's because when you're doing that conversion over, people don't believe the customer growth story because you're converting customers you already had for long-term relationships in the professional services side, moving into your customer base as regular SaaS, and usually it's cheaper in the short run for them. Or so you'll have to show new customer journey growth before you get a healthy valuation. I would encourage you to look at the angel market, who are much more forgiving in those early stages while you make the conversion, and it'll probably work better for you. So, probably raise now a small amount of money if that's what you need, in order to help you grow the new onboarding of new customers to show that your product is not just built for your existing professional services customer base, and that you can find new and perhaps better customers as you go forward, and show that curve.
Yeah. So I think, funny enough, my first company that I was in charge of taking care of when I joined one of the incubators, so previously was with the DMZ, was a company that was doing sort of that transition, going from more contract sort of consulting basis to more sort of recurring subscription basis. It was super painful to watch them actually go through that. It was a very, very long process. And then second, the conversations that they were having with investors took a lot of time, a lot of negotiation, a lot of structuring, just because they had to convince the investors that, like, yes, the majority of our business is now sort of on the subscriber side. And moving it to the subscriber side was just very costly for them. There was a lot of downtime, there was a lot of work, there was a lot of maintenance, and a lot of sort of pivoting and transformations along the way. Just sort of like my 2 cents there. There's another question from Paul. What's the best way to decide fair market value of a SaaS startup company?
So there are lots of comparable tools on B2B SaaS, right? And so you can go and have a look at it. My knee-jerk reaction is growth rate times margin in the earlier stages. You're going to start getting a very clear sort of, and it's that growth rate that makes how far ahead we will pay you on your forward-leaning revenues. If you have a very healthy funnel that we agree with, then you'll get a better valuation on those early stage B2B players. The margin is important there as well in order to give comfort, but for that forward valuation. But it's how much on the forward valuation annualized we'd want to go based on what we see there. So
yeah. So next question from Kalkin. What are your thoughts on methods like Berkus method, scorecard valuation method, etc., to value business?
I haven't thought about the Berkus method in a long time. That's not to dismiss it. I think I'm trying to remember. David Berkus is like one of those famous sort of intellectuals who write interesting books. And it's a perfectly legitimate way to think about how you'd want to do valuations in the earlier stages, particularly around angel rounds. With us, there's a little bit more market dynamics going on as how much we've been dealing with something that the Berkus method doesn't take into account. It's opportunity cost of not doing this deal because we apply ourselves to the valuation methodologies too aggressively. So the reality is there's a lot of money coming into venture capital right now. And sometimes we have to pay ahead of what the multiple should say it's worth in order to just get access to that deal. And that's what you see with some of these crazier valuations that are going on out there. So Berkus doesn't take that into account. And neither does the scorecards. They're good methodologies for making sure you have clear objective analysis of what you think the company, what stage you think that company is at. And people use those as part of their IMs and investment memorandums, but I don't think they use them as part of their valuation routines anymore.
I honestly just look at just reading those names and actually going back and just trying to remember the way they were actually done. I mean, more often than not, from what I've seen personally from the incubator side, even back when I used to work at a seed stage accelerator, I used to sort of write 50K US checks. This was back in the Middle East. The method that we would usually use was we just essentially figured out, hey, what's the round size? What are you asking us for? And then just kind of working from there and trying to figure out what the different valuations and the different sort of stakes are. Just quick sort of napkin sort of calculations and just kind of doing the negotiations there. So that question's done. So this is from Senthu. How's the outlook for marketplace startups among the VCs? Do they consider it the same as e-commerce platforms?
Maybe depends on what goods are being sold and pushed through. So it can some marketplaces can look like e-commerce, and some e-commerce places masquerade as marketplaces and trying to get better valuations. But the outlook is very positive. There's a lot of strength out there, but there's a lot of people who are worried that they're getting into e-commerce plays with some of these marketplaces. A lot of good marketplaces come from the e-commerce side. They start there and they sort of gravitate into a larger marketplace story. So people like me are a little bit less scared of them, but you know, they have to be very special in order to get attention from people if they're an e-commerce play.
Yeah.
There's a great robust network of VCs out there now for e-commerce. So if you're not really a marketplace, you know, stay an e-commerce play and just go to those VCs. But in Canada, e-commerce, surprisingly, e-commerce is not very well invested in. That's because a lot of the Canadian VCs just lost their shirts doing it, so they're scarred, I guess.
Yeah. Quick, good resource on Marketplace. Version 1 has a manual.
Yeah, Angela and Boris have written
yes.
some great sort of, every year they updated this like marketplace analysis.
So it's the Marketplace handbook. Just go to their website. I think you probably find it like just in the top sort of like ribbon or tabs or whatever you want to call them.
Totally worth a Sunday afternoon read.
Yeah, like just really, really fantastic stuff. Question from Culkin again. How's the outlook for digital health startups? The space is getting crowded, but there has been an insane amount of dollar flow in the digital health space.
Well, we're all at home because of COVID, so I guess we all care about digital health suddenly. Like this has been the storyline for the past 3 years. Like digital health has just been coming online. I think the willingness of lots of earlier stage investors to get involved means that you're seeing a lot of later stage investment coming in as well. So you know, I think all in all, we're in a place where you know, digital health is going to continue to be great. I think Canada is well positioned for it, but there's a lack of early stage investment in it on the Canadian side, or there has been in the past. Maybe that's changed, but I think it's a great place to invest. I think there's a lot of great companies there. We have FedStack in our portfolio, which is doing very, very well.
Thank you, Matt, for that. It's Christina back. So we did hit the top of the hour. I know that went fast, lots of good discussions. So I really wanted to take this opportunity for thanking our audience for joining us today. And a special thank you to Laith and Matt for joining us and sharing all of their great perspectives and insights. Really appreciate your time this afternoon. Just a reminder to the audience that if you'd like to connect with Matt or Laith further, they will be doing office hours with Communitech. You can reach out to get registered for that or get more information by emailing investor@communitech.ca, as we do have an investment readiness team that's working closely to help make those connections. And one last reminder that we are running an Ask Me Anything session on cap tables on June 1st. So some of you may also be interested in attending that if that's something that you're thinking about setting up or figuring out how to best manage. So with that, again, thank you everyone. Stay safe, stay healthy, and thanks again, Matt and Laith, and hope to talk to you soon. Have a great day, everyone.
Thank you for having us.
Bye.
Thanks, everybody.